should put one of those Alice in Wonderland drinking stickers on my monitor. Okay. Access to this webinar is for educational and informational purposes. Only consult a licensed broker, registered investment advisor before placing any trades. All securities and orders are discussed and tracked and monitored. Virtual trading accounts, virtual account prices, and returns may differ from actual trading results. Commission costs are excluded. Neither BillStockloan.com, PSW, nor its affiliates, or any of their respective officers, personally or representative agents, or independent contractors, or in such capacities, licensed financial advisors, registered investment advisors, or registered broker deals, nothing from the webinar website or promotional material constitutes zero motion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks and standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above promise from any losses you may incur as a result of the information discussed in the media identified above. By accessing the webinar, you agree to be placed on a mailing list and receive our newsletter. Rest assured, we will take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, fantastic. I love legal stuff. All right, moving onward and upward. SG says no sound. Gonna have to restart SG, although it doesn't help by try restarting. Oops. Restarting. And Wayne has an immediate question. I have May 95 long puts on Chevron. Oh, so do we. Do we? Was it May? I forget. Oh, well. I know we did something. And, well, first of all, well, May 95, you're in trouble. Is there a short April put that you could suggest that I can sell? And, oh, that's right, we bought April puts. We just did this on, when did we do that? Friday? I forget. Very recently. Hang on, I'll tell you. It's in our, oh, I can show you, in fact. In our, must be the short-term portfolio for a trade like that. Let's take a look. I guarantee this trade is not making money, so we'll see how it looks. Chevron, Chevron, Chevron. There it is, okay. So, when was the 9th? Oh, it was early in the week. Okay, so it was Wednesday, third Wednesday was when we started the trade, and this one didn't fill until the next day. What we did was we sold 10, I think the number's wrong. All right, anyway. So we sold the 92.50 calls because we thought Chevron was too high. Now, so far we're wrong. It's not too high, or it wasn't too, I mean, well, I don't want to say we're wrong, it wasn't too high, but I will say, oh, where's that little tricky chart? Hang on. Dun, 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 dun. This kind of chart. Open a new tab. Okay. So when Chevron shot up here, which was like last Wednesday, right? 1, 2, 3, 4, 5, right? So right about here, we figured 95 was not going to get topped. So we were looking for a rejection up here at 95. It's kind of hovering there, which makes me a little bit nervous. But, where was I? So what we did is we sold the 92.50 calls. So that's how much we thought it wasn't going to hold it. Is we sold the 92.50 calls, not even the 95, and we collected like $4, right? Yeah, we collected $3.90. It's now over $4, and we used that money to buy the 90 puts. But I think we were supposed to buy 20 of them. Frankly, I don't think we should have bought 10. I think we were supposed to buy 20. I honestly don't remember what that play was. I'll have to look it up. But anyway, I believe the intention was to buy 20 of those and have a neutral trade. So what our thought was it was certainly going to be lower, but we weren't sure how much lower. Hang on, I think I found it. All right, let's see. This is 20. Yeah, there was supposed to be 20 puts. So my bad, I have to fix that entry. I knew that was wrong. Anyway, so the idea was to have a basically zero-cost trade, and the idea was that when Chevron went down, we'd make money on the puts, sell those, take the profit off the table, and then we have a free upside of whatever it was. It's still a free upside. I mean, if we take 2,000 off the table, well, if we take 1165 off the table right now, and these expire worthless, we still have a $1,000 profit, okay, in pretty short order. So nothing terrible has happened yet. Oh, I'm sorry, it would be a $2,000 profit because this is supposed to be 20. But, I mean, it's risky, of course, because Chevron could go up. You have to be realistic. But I don't think so. And you know, we're watching oil pretty closely, and I don't see oil really getting above 40, and this is kind of a ridiculous price for Chevron. And why is it a ridiculous price? Because here, look. Did we talk about this last week? Maybe we talked about it last week in the thing. So here's Chevron, and last time it was at 95, was last year. It topped out at 96, but you see it didn't even last over 90 for very long, right? Very, very short time over 90. And that was October, November. So now you say, well, okay, so Chevron was for a brief period of time, and only a very brief period of time last year, since summer, were they over. Now, WTIC, when we look at the price of oil, and you see basically oil was up at $50 for Chevron to be up at 95 bucks. Okay, and Chevron had come back to 95 after being much lower when oil dropped from 62 to 37. So maybe you can say it overreacted a little bit on the way down, but realistically, at $40 oil, there's no way you can justify $95 Chevron, and natural gas, of course, being another part of their operation. In fact, if we look at Thinkorswim, and we go to Chevron, this works for majors. It doesn't only work for big companies if they have a profile. But you click on the profile and look at, and we did do this last week. I remember doing it. So there's 65% oil and 20% refined products and 15% natural gas. So they're just a regular oil company. There's nothing special about their operation that should make them any different than anybody else, so they shouldn't be so high. They're overpriced. That's the bottom line. Oh, look at the market coming down. How nice. All right, let me talk about that for a second. Well, our big shorting line with the S&P at 2,000. Now, don't forget the Fed's coming up, but any crazy shit can happen with the Fed. So you got to be really careful here. But we see how 17.2 failed on the Dow? That's good from a shorting perspective. And 2010 failed on the S&P. And 4350 is essentially failing. Well, we're at 4350 on the NASDAQ. We'll see how that does. The Russell is already heading back down after trying 1070 and failing it. And the Nikkei is down 16.9 still. So it's more, I mean, it's drifting along. It's kind of flat. But it's encouraging for bearish bets right now. And the dollar's not particularly strong. It's still under 97. Oil came up nicely. Oil's over 37.50. 37.50 is like this red line. That would be resistance 1. I'm pretty sure we'll drift around there, though. I don't think we're going to go much higher. Natural gas is over 205 on the M contract. We're on the M contracts now. Aren't we? Wait, what's M? June. M is June. What's N? Can we do N? That must be July. There's July. If I was going to buy a new contract, and I am because we stopped out of our contracts last week, I would kind of think maybe July is better than June. I'm not sure. Let's see, 216 for that one and 206. Would I pay 10 more cents for July? Well, how much is May is K. 195. So I'm already paying 10. Yeah, well, if I'm going to pay 10 cents for June, I may as well pay 10 cents for July, I guess. So I guess on the whole, I would look at the N contract, not the M contract. You know, it's always good to have a little bit more time, and generally you don't get too screwed by it. I mean, until you get to that month and you still haven't made any progress. Just like any option, you're paying for the time. Gosh. So 220. But it doesn't matter what it is. It matters how it corresponds to the regular contract. So basically, you have the July contract N6, which corresponds to the current contract at 187. So 187 and 216. So it's 30 cents higher. So basically, it's 10 cents a month because the current contract is April. So you're paying for May, June, July, 30 cents. You're paying 10 cents a month. That's pretty straightforward. So I guess that's fine. But on the whole, though, we cashed out that natural gas place that had a nice run into Friday. We didn't really think it was going to go much higher in the immediate future. And, of course, it often goes down on Monday, so there was no good reason to stick it out. That was over here. We did go down on Monday. We didn't jump right back in because it was such a small drop, but then it had a big rally. Now it's kind of holding up here. So maybe it is consolidating for a better run. And if it is, that's fine. And that's why we have the UNGs, though. We have a lot of UNGs. You know, you play the futures when it's obvious. But, whoop. Oh, I forgot to mute people. Sorry.
You are now muted.
There we go. So, you know, we play the futures when we think something is obvious in short term, but when we just have a long-term play, we play the options and just don't even bother. You don't have to trade the futures. They're not in this portfolio. They're in the long-term portfolio, but we have some UNGs. How's that long-term doing? 71%. Very nice. How much money is that? $885. Man, when this gets to $1 million, I'm really going to want to cash it out, man. I have a big problem with holding on to $1 million portfolio when it's up that much. UNG, here we go. So we have this UNG here, and this is pretty aggressive because we have the $8 calls, we're not even there, and we have the $10 puts. I mean, it shows you how wrong we were when we entered. I will press this position though. When we review the long-term portfolio, I will press that position. And in the options opportunity portfolio, which is still called 5% portfolio here, that was the original name, we're now up 23%. And how much? Wait, well, obviously it's $123,000. And here, our long-term play on UNG is also 2018. We have the short puts too early. We have plenty of them. We have the bull call spread, 5 and 10. Okay, and that's what we're looking for. So if all goes well, if we hit 10, though, this thing's going to be, this $12,000 goes away that we owe, right? So that's plus $12,000. Then the net of this spread goes to $10,000 from currently about $3,000. So that's plus 7 and 13. So just about 20. There's $20,000 to be gained in this in the freaking 5% portfolio. In a $100,000 portfolio, we will make $20,000 if natural gas hits $10. If UNG hits $10, which is roughly natural gas getting to $3 by 2018. So that's our bet, and I don't need to play the futures when I've already got a $20,000 bet that natural gas is going to go to $10 in the long term. The futures is just, in fact, more to the point, I shouldn't even be playing natural gas except for with that bet on the table, I shouldn't really be messing around much with natural gas except for shorting when it gets too high to lock in the gains I make. So if it goes high, if it really did spike up like it did on Friday, we would have been almost better off shorting it to lock in the gain of our long-term positions. It didn't work that way because we were already long from a much lower price, but hopefully you get the idea. The point of the futures is that you've got an ability to hedge your bets in your portfolio, not just to bet the futures for the sake of it. The point is to use them for hedges to lock in gains and to hedge any kind of downturn that you weren't prepared for in regular trading hours. That's the main use of the futures. It shouldn't be a gambling mecca. It's not a craps table. All right. Now, where are we? Yep. Okay and okay. Oh, wait, that's all. I'm like, these are not big questions. All right. What if the short position goes against me? One of my options on the short. All right, so that's the gist of that. So that's what we have, and I mean, if you want, again, we have it with an offset. You don't I just had this conversation in the member chat this morning because somebody else was making big put bets. Wait, short put? What short put? I'm all confused now. Oh, the Chevron. That's a long put. What are my options on the short put? That's totally different. We don't we don't want to pay premium. We didn't pay premium for the Exxons because we sold the calls, used that money to buy the puts. We didn't pay for the puts. I don't take money out of my pocket to buy out-of-the-money options unless I have a specific reason, like maybe, let's say Vertex, right? If I was going to play Vertex, VRX, I wouldn't because I think they're dead, but that's beside the point. But if I was going to play Vertex and I want it to be bullish, they're the ones that with the drug company, it's completely in the tank. All right. So if I want to be brave and go long VRX here, which I have no particular reason to, but let's say I thought they might come back to 60, I would rather buy the $40 calls or the $45 calls, assuming they're not too crazy in money, and I bet they are crazy in money. VRX. So let's say I figure that somebody's going to step in and say something to save them a little bit next month, okay? So you look ahead and I say, oh, look, the $45 calls of April are $1.50. All right. So rather than doing something stupid like selling puts on the stock, because I don't really want, if they get worse from here, who the hell wants to own them? They're probably heading for bankruptcy. So no matter how attractive the short puts look, they're not really attractive because I don't really want to own them. If you don't really want to own something, you should not sell puts on it. And you have to think of the conditions. So in other words, the only reason if I sold these 35s for $6 or $5, whatever, I have a net $30 on the spread, on the stock. But if VRX is at 30, do I really want to own them? No, because if they're at 30 in April, there's some ongoing tragedy. That means that they're probably going to die. So I don't really want to own Vertex. There's no sensible way for me to play along on Vertex. But as a bet, as a gamble, you figure if they're going to turn it around, which they're not, and again, this is only an example because I do not believe in this company at all. Still, if I was going to gamble, I would take $1.50 and buy these April 45s because at least my loss is limited. So I take $1,500 and I buy 10 of them, of the April 45s, and the most I can possibly lose is $1,500. There's nothing that can happen that can cause me to lose more than $1,500. And if they go to 60, though, I'm going to get $15,000 back. It's a 10x bet. I can do that because a 10-to-1 reward. Back to the chart. So a 10-to-1 reward for them going back to where they were yesterday morning. Okay, that's a gamble. Now, I think there's less than a 10% chance. I wouldn't even make that play because I think there's less than a 10% chance of winning. But even assuming you win, the point is, if those are the kind of plays you make and you make them 10 times, like, look, had you made that play here, you would have been really happy, right? You would have made $50 on your, or $40 on your trade. So had you made that bet here, you would have made $40 times 10 is $40,000. All right. So here it worked out if you caught the knife falling. Now not this knife though. This is a big candle down. See this big candle down? This is somebody was playing it yesterday in member chat. I told them, don't do it. Don't catch a knife. And it's exactly what happens. It's actually worse today than it was yesterday. So you don't want to be the first guy in. You want to wait for it to start forming a bottom of some kind. But if it does form a bottom around here and you pick up those options, then you'll be this guy. You'll be the smart guy who picked up this option here and then let it go all the way up to here, and you just drop the money in your pocket. You can make those bets 10 times, and you only have to win one time. You only have to get it right one time, and you get all your money back. And if you get it right twice in a row, you're going to be a happy camper. All right, so that's the logic of those kind of bets. That's what you use those bets for, to limit your downside when you have a tremendous upside and you're taking a flyer on a chance. It's not, though. Don't ever think that's an investment. I mean, seriously, the guy in the member in PSW this morning, I think it was Tangled, he bet $15,000 on two companies. betting long puts, and he wiped out basically $15,000. And I'm like, well, I mean, as long as you learn something, at least it's like cheaper than going to Wharton for a semester. But that's about all you can say that's good for it. You own nothing. Okay, you don't make a big bet like that. It's the same thing as betting on 11 on a roulette table. It's like, might come in, probably won't, but it might. You know, when you're buying these plays, you have to really, really think about your statistical probability of winning. And if you don't win, you've got to be able to just go, oh well, okay, next bet. You know, when somebody tells me, oh, I lost this on this one, I lost this on this one, and you look at the numbers racking up, I don't care who you are, you don't want to lose $15,000, $20,000 on 2 bets. It's probably too much. I mean, unless you're the kind of guy who literally does take $10,000 chips and toss them on the craps tables and picking a number. You got to really think about what you're doing when you make these kind of bets. They're incredibly risky, no matter how smart you think you are. Let's see, meeting time. Okay, yes, we were supposed to buy 20 of those. Chevron. Yeah, well, of course, Chevron. I mean, look, those analysts, they might have a lot of analysts on the side of the wall, but they're wrong. Also, really, you have to qualify the word analyst. I mean, I'm sorry, but an analyst isn't every single guy who writes for the Motley Fool. The quality of analysts these days is tragic. It really is. I mean, they just don't know what they're doing. And I think part of that problem, though, is that the people who actually write for the public obviously can't make money. Okay, because Goldman Sachs hires 10,000 of these people, and so does J.P. Morgan, and so do all these private hedge funds, and so on and so forth. There are millions and millions of private analyst jobs where you get 6-figure salaries and stuff like that. If you're reading some free guy writing in the newspaper, if he's making $50,000, he's a top-paid analyst, quote. All right, these guys just aren't the best. They're really not. And even the professional ones, so the ones that write for the public, they're not the really good ones. Okay, the really good ones are the ones that are sending out the private letters telling you what's going on. So all this crap you hear, they're not analysts, they're PR people. Okay, that's what you have to realize, is when these people who are labeled as analysts are really PR people whose job it is to move the stock one way or the other. And they'll write whatever to sway the opinion. But what you got to look at is, do they actually know what they're talking about? Do they have any kind of track record picking this stuff? And how does anyone? I mean, I guarantee if you look back, the analyst, I believe, is the one who is bearish on Chevron and changes their mind at some point. So if you look at Chevron, okay, were those analysts telling you to be bearish at 100 back here? And it's not hard, though. I mean, look up the analyst that's writing and do a Google search on him and find out what else the guy's been writing about and see if he's an idiot or not. Okay, did the analyst start telling you to buy down here when it was at 60 and 70? Did the guy say to buy? Or did the guy come in now at 96 and say, oh, buy? That's not being an analyst. That's being a trend watcher. That's writing articles that people are clicking on, which is also a disgusting part of this business. But look, I blame you guys. I blame the consumers, because the consumers, you get what you pay for. And the only thing you're paying for is with your eyeballs. Most people who don't subscribe to something and don't pay money, the only way you're generating any income is by looking at things. So therefore, people write things you're going to look at so they can get the ad money off your eyeballs. They don't give a crap about you other than that they engage your eyes for a certain amount of time so that 0.1% drops into their pockets from the Google AdWords. I mean, it's what the industry is about. I mean, I love all these capitalists who think that there's this incredibly good-natured group of analysts who are trying to help them out for free and are competing to do the best possible free job they can to make you happy. It's completely bullshit. But the same guys who sit there and argue with me about being staunch conservative and tell me how this is not how the world works and you've got to be realistic are completely unrealistic in their own investing. It makes no sense. Okay? It's just like anything else. You pay for quality work. You know, if you pass by a place that says free tire change, you know, says free, you know, for your car. If you drive by, you're driving along the road and you're in the middle of some nowhere place and you see a garage that says free tire change, free tire rotation, you probably aren't going to stop, right? Because you're like, oh, it's got to be some kind of scam. You know that, right? But when you are on the internet and you're browsing and you see free financial advice, you start quoting it frickin' back to me as if these guys know what they're talking about. They don't. Very, very rare. There are some good people who write, obviously, could fall through the cracks. There's millions of analysts. There are several people who are actually good at their job. I just wrote about this morning about one of the guys who's actually a good economist. I have zero, you know, economists are another one that there's way too many of. You know, there's no test to be an analyst or an economist. You just get to basically stick your name, you know, you get to stick your sign on the door and say, I'm an economist, and then you start writing. And as long as you write something interesting that people click on, newspapers will carry you. It's really sad. It really is. I mean, I notice it a lot because I get interviewed by a lot of people these days. I sometimes look at like the next guest after me, like I watch what I do, and I watch the guest before me or the guest after me, and I'm like, oh God, I can't believe I'm on with these people. And the news people, they don't care. They treat everyone the same. They treat everybody like they know what they're talking about. You know, it's up to you. You've got to be the one that vets these people and figures out if they know what's on the ball or not. JW says, I think you're selling 2018 $80 puts. What happens tomorrow if Chevron moves to 75 and you're assigned the stock? It's not me. We bought puts. We expect the stock to go down. We're not going to get assigned because we own the puts. How worried were you about the roll cost of contracts in the UNG ETF? Day trial, you mean not the roll cost, the decay, well, the cost of decay. Internally, there's a decay because they have to pay to buy the next contract and next contract and next contract. Yeah, so that is essentially what they do. I believe that UNG has a strip of 12 futures contracts. In fact, let's find out, okay? Let's be an analyst. All right, so we say UNG ETF. Fact sheet, there we go. Oh, holdings, even easier. Okay, so what do they hold? Okay. UNG segment size committee. They hold several times more assets, blah, blah, blah. Like a benchmark, it rolls expiring front month contracts to the nearest month. Oh dear, no, they don't. Isn't that interesting? See, I thought they didn't. So basically it says right there, it's very easy to find these things out. The fund also leads to segment liquidity. They roll the expiring front month contracts to the next nearest month. So they do. They lose 10 cents a month. How much is 10 cents? 10 cents out of 661 is, like 2%. So every month they're going to lose 2% if you assume the 10-cent spread is constant. So over the course of the year, they're going to lose $1.20, which is 20% of your contract price. All right. So given that, now we took that into account, of course, when we looked at natural gas, because we think natural gas will be up 50% from $7. 50%, so $7 plus 50% is $3.50, is $10.50, and then we take into account the fact that it'll pull back a little bit, and that's why we have the 4.9 spread as our main spread on natural gas. 4.9. Because we're saying $10.50 minus $1.20 is going to be $9. That's our target based on the fact that we think natural gas will be up at least 50% from where it is now. And yeah, you have to know this stuff. I mean, you have to take it into account, but that doesn't make, and as I was saying to somebody yesterday, they were like, well, in that case, you shouldn't play it. I'm like, no, you don't have to, doesn't mean you don't play it, it means you have to play it intelligently. If you play baseball, right, and you have to adjust your swing sometimes and whatever, but if you're playing baseball and you keep hitting it to left field when you swing, okay, sometimes rather than adjusting, you actually, just go, okay, fine, I'll accept the fact that I'm going to hit it to left field, and you look to find a spot in left field that you try to knock it over to. You know, you take what you're given. Same thing for a gun. If a gun shoots a little bit to the left, you aim a little bit to the right and shoot. Okay, it doesn't mean you can't use the gun. You don't say, I can't use this gun. It's a little off left. I mean, some people do. But, you know, you pick up the gun and go, okay, fine, I'll adjust. That's why people take more than one shot at the target. First shot tells you which way the gun drifts on you. And meanwhile, the gun can be aligned perfectly straight and your eyes can be screwed up. But either way, the combination of whatever you're using, and that's what we do, the combination of the options. And the reason on UNG that the reason you get paid such a stunning amount of money for the puts is because there's the presumption of decay. All right, so you take these $5 puts there, 86 cents. That's ridiculous. That's $4.20. It's at $6.60. That's 33% lower. All right, so it's not going to decay that much. So you're getting paid a lot of money, partially because of the expectation of decay. That's why you get such crazy money for it. Now you can use that to your advantage. The same thing goes to the $5 calls. They expect it to decay. So they're much cheaper than they would be otherwise, because honestly, it's at 160 above now. So you're getting these calls for 210. You're paying 50 cents more than the actual price for the $5 calls. 50 cents to have a call on natural gas for 2 years? There better be some decay in that, otherwise that's one of the cheapest options I've ever seen. But that's why it's priced like that, and you take advantage of it. You got to learn to play the hand you're dealt, as the old poker people will tell you. JW, my question is, you are assigned the stock even though you have perhaps sold a put out to 2018. You can't, if you sell a put, you can be assigned any time. Anytime. All right, so if I sell a short put, and I said, I'm willing to buy this stock for X amount of money. But if they assign it to you, you keep the money, you get the stock for the net price. So who's going to assign it to you unless that net price and the put is better for them than the money? So it has to be well below the money before you're going to get assigned. There has to be almost no premium left in the put contract. It very rarely happens, and it almost never happens with something that's not deeply in the money on a short put. And again, what I say at the beginning, though, don't ever sell a put in a stock you don't actually want to buy. That's all. In the long-term portfolio, where's that long-term portfolio? Here it is. In the long-term portfolio, we have 28 short puts. We have Alcoa, we have Anthem, we have Sotheby's, we have BP, we have CCJ. I don't actually want to buy CCJ. We're going to dump them. We have CHL, that's China Mobile. We have Cleveland Cliffs, we have CM Chipotle, we have CMI Cummings, we have DBA Agriculture, we have Encana, we have Exelon, we have Expedia, we have Gilead, we have Harley, we have Intel, we have Coffee Futures, we have Michael Kors, Mattel, Manitoba, we have Mylar, we have Seagate, we have Stanley, we have Target, we have Target twice? That's a mistake, that has to go out. We have, I'm pretty sure that was, yes, that's some kind of a double entry. We have Target, we have USO, we have Whole Foods, and we have WYNN. Every single one of those sounds good to me, except for except CCJ, who we decided to give up on. Uranium is messed up, man. Uranium is a really, really messed up thing. It's just this, we thought they'd be restarting reactors by now and building new ones and increasing demand, but it's just not happening. It's too slow, and so we're just going to give up on them. But all those other names, even the CMG, because we got to get a price for it, none of them make me say, "Oh, I don't really want that." In fact, I was just saying, "Dad, I want more Alcoa." We should probably. I don't want to add to this one because we already lost a lot of money on it. I want more Alcoa for sure. Sotheby's we already added to, but I would add to that. 10 is not many. We can add to that and get a better price. Look at that, $11.95. We absolutely should add to that one, in fact. Who else is there? Cummings. Well, they'll come back eventually, and we have it's a very early entry. We only sold 5. That's a really early entry. We can certainly do more. Other than that, these are mostly making money. And then we've got oil, and of course we also feel oil is going to come back by probably by the summer. So none of these things are bothering me, and they're all perfectly good stocks that we'd love to buy if we were lucky enough to get them at such a cheap price. You know, that's our logic on those things. So if they're assigned, that's not a problem. If they're not assigned, 8, 10, 20, 30, 40, 50, 60, 70, 80, 90, 95, 100, 105, 110, 115, 120, 125, 130, 140. So there's 150,000. So either we're going to get 150,000, all this becomes profit. If they don't get assigned, if they go up, these are all profits. So we might make $150,000, and this is on a $500,000 portfolio. That's 30% profit in 1 year. So in about a year, we'll pull a 30% profit on the portfolio, or we'll own some of these stocks at very low prices. You know, we'll own Cliffs at net 4 minus 280, net 120. It's at 220 now. Okay, we'll own China Mobile. We'll own China Mobile at $51. It's at 55 now. We'll own BP at 35 minus 10 is 25. It's at 29 now. That's what we're doing. And if we own them, then they go down here where we have stocks. I don't have a problem with that. We own one. We like stocks. We have plenty of them. But you know what? The reason we only have 20 stocks and we have 28 short calls is because we hardly ever actually end up owning the stock. It's very, very rare that a stock gets cheap and stays cheap long enough for us to get assigned or to convert to the stock. Generally, these expire worthless. We take the $150,000 in cash, we put it in our pocket and say thank you very much. That's the thing. And basically, we do these once a month. So in fact, we're right on track. And you know, we're not right on track. We're a little bit ahead, even though I have 2 of these the same, which should be 27. But pretty much once a month, we sell a put. That's the gist of our program. And then they expire and they roll over, and every year a dozen of them roll over, and we sell a dozen more. And that's and don't forget, it's on a $500,000 portfolio. We're talking about selling. We try to sell $4,000 to $5,000 a month. So we're picking up $50,000, $60,000 a year for promising to buy a stock if it gets cheap. Okay, we get paid to pick stocks that we'll buy if they drop 20%. That's the best strategy in options of all. The only reason we ever end up owning something is if it's already 20% less than where we liked it in the first place. Isn't it 10 cents off the NG contract price, not 10 cents off the UNG price? Oh, I'm sorry. My mistake. You're right. Wasn't that rollover? That's a very good point, Stan. So yeah, that's actually a much bigger headache than I was thinking. So at these prices, that's a very punishing rollover amount. But it's not 10 cents though, by the way, because what you have to compare is the actual front 2 contracts. But yeah, it's extreme. If you're paying that much money when it's this low in price, it gets kind of extreme. But what's the front month contract? Is J6. NGJ6. NG. Yeah, okay, so the front month contract is J, and the K6 contract, the next one, 186, 195, damn. Well, it's an unusually wide spread. All right. But yeah, you're right. I'm sorry, it's my mistake. So 10 cents is severe on that price. UNG can't be paying that kind of money though, because they're not decaying that fast. Although they did, we noticed that though they did have a bad batch of decay recently. So so that's true, because we said in fact we were talking about that yesterday in member chat because if you look at UNG compared to natural gas, they were basically neck and neck for a long time, and then the last month or so they had a pretty UNG lost ground, and they did lose ground, I believe, because that rollover got to be a much bigger percentage of the contract than it usually is. Because yeah, you're right, that is punishing when you look at it as a percentage of the NG contracts. All right, and I'm not going to say I haven't studied UNG closely enough to say exactly what their percentage loss would be in comparison, but it isn't 10% a month. I mean, you can tell that. But but obviously, if there's that much of a contract gap, 5% or whatever per month, that's going to be very punishing if it holds up like that all year long. But, of course, the reason that there's a 10% gap month after month after month going forward is because nobody believes natural gas is going to stay this low going forward. So there's a tremendous, a big curve in the prices going out to longer terms. How do you determine a strike price when selling a short put? Well, I mean, you first of all determine the price that the stock is worth. So if we pick a stock, like who are we talking about this morning? What was the good one? Oh, Chipotle. Okay. Let's look at Chipotle. All right. How weird. How come this thing shows the old Yahoo? I can't get I like the old format. My new computer, my other computer will not show me this format anymore. And I swear I'm not doing anything different. I hate the new format. All right, here's Chipotle. They've got a $15 billion market cap now. Oh, wow, did they come back? Holy crap. Because this morning I was saying how ridiculous. I was on Benzinga Radio during the morning. They were doing the pre-market show. And they said, what's the number one stock for today? And I said, Chipotle. I said, what kind of idiot is going to, it was down like 480 before the open. What is that? Why is it like, isn't that weird? Like, why does it not have earlier? Let's see if I can get it up here. CMG. Log in. Can I log in? Yeah. Log in. Like I paid for this thing. I should be able to get it. CMG. There we go. See, you pay money, you get this chart. They opened at 473. And at the time, I said you got to sell these the puts, the 2018 400 puts, and I think they opened. I mean, they probably opened at 50, but nobody actually bought them for that price. Nobody sold them for that price. They came out at 45. So what are they now? So they're 42 now. That's not so bad. Anyway, so if you sold these puts, the 400 puts for 45 at the open, you're netting to CMG for the 400, which is your net price, less the 45 you sell them for. So that's 355 is what you're net paying for Chipotle. All right, so that's 355. All right, and then you're promising 100 shares, so you got to be. So you're promising to buy. Whoops, that was terrible. You're promising. Anyway, trust the math on that one. You're promising to buy $35,000 worth of Chipotle. You're collecting $4,500 for a contract up front in exchange for promising to buy $35,000 worth of Chipotle. Now, how do we pick the price? I want to be safe in this particular case. So they were at 470. They held 399 before. I feel pretty good about it. I know this from last time, so I'd already done the calculations when we were down here last time. That's why they're in that portfolio at this price. But when it was at 400, I said, boys, that's ridiculous. And why is that? Because it's $500. They have a $15 billion market cap. So take 20% off that at 400 would be 20% lower. That brings them down to a $12 billion market cap. Now, how much money do they make? Annual data. Okay, they make $500 million a year. All right, their operating income is $763 million a year. But let's say they make $500 million, drops to the bottom line. Now, quarterly, how have they been doing? They're actually increasing nicely. They're on a pace to do $600 million this year until they have their little E. coli thing. All right? But there's nothing lasting about that. So figure they're going to be good for $600 million a year, and when you get to 12, when you're at a $12 billion market cap, the PE is down below 20, okay? It's not 33. It looks like 33 right now because they're running through a bad patch. But, you know, like the burrito, this too shall pass, okay? And it will be gone. It'll be in the rearview mirror like Yum. Remember Yum Brands was killing people for a while? Remember Taco Bell was toxic and people, my kids still to this day won't go to Taco Bell because it kills people. Because when they were kids in elementary school, they remember that there's something very bad happened at Taco Bell and that the food killed people or hurt people. That's all they know. They were young. They happen to be just at that age. When I was a kid, it was Jack in the Box. Jack in the Box. There's no Jack in the Box on the East Coast. Now, to this day, there's still no Jack in the Box on the East Coast because back when I was a kid, Jack in the Box, which was my favorite thing to do when I was a kid, we used to go because they had the little bouncy clown head and you talk to the clown, which seemed like a cool thing at the time, and he took your order. The clown that took your order apparently was killing people. So that's all I remember about Jack in the Box when I was a kid. The people were dying or whatever, and who even knows if anyone actually died. But when I was a kid, that was what happened to Jack in the Box. They actually shut down their East Coast stores. They retreated back to the West Coast. They're still out there in the West. So until I happened to go meet my wife's family in Texas, when I'm like 35 years old, I hadn't touched a Jack in the Box. And I traveled around. I traveled for years all over the country. I saw Jack in the Boxes, but as a business traveler, I never even considered buying a Jack in the Box. You know, in 20 years of traveling, I didn't even think about putting one in my mouth because that one experience in my childhood put me off it for so long. All right? But on the West Coast, huge chain, great, you know, huge growth, fantastic profitability. They just stayed away from the East Coast and never came back. All right? But, and I went, you know, and so I meet my wife's family and everyone's going to Jack in the Box. I'm like, really? And they're like, it's kick-ass. And I was very surprised. They have sourdough buns. They're great. So anyway, so the point being that this all washes away. It only really affects the people who actually are of a certain age and remember it, and it passes so quickly, like in Taco Bell thing. I don't like Taco Bell because the food is disgusting, but I don't stay away from it because a few people got E. coli. That's just part of life. It happens. You know, and Chipotle, if anything, is overreacting to this thing. So it'll wash away. They're going to go back to being a high-growth stock with a 20 PE, which is lower than anybody else in the sector, and it becomes a bargain. So that makes an easy target for the short put. And not only are we getting that price, not only are we 20% off, but we're getting another 10% below that. We're looking at a 30% discount to the current price. So that's how you determine it, by good old valuation metrics. You've got to look at it, value it, think about the situation, think about the worst case, and think about where you're willing to own it. JW, in other words, you wouldn't roll it to the shorter strike. You'd rather own the stock if it goes below your short strike. No, it depends. It always depends. It depends on the current information. It depends on what it is. It depends on how much you really want to own it. Maybe you want to double down on it at this particular point. Maybe you want this. Everything has to be analyzed for the point of time you're at. Why did you get assigned? Why did the person panic? What horrible, like let's say it was Vertex. If I got assigned Vertex right now, I'd kill the thing. I wouldn't roll it. I don't want more. I wouldn't double down. I don't want more of it. I think it could go bankrupt on me. I take my loss and go home. Okay, but if it's Chipotle and I got assigned Chipotle tomorrow, I'd either roll it or buy more. But I probably wouldn't put a lot more money into it. But I certainly wouldn't mind being assigned. And also, you got to look at the price of the options when you're assigned, because maybe it's advantageous at that moment to sell calls against what you got assigned. Or maybe you just cash it out and sell puts again.
But being assigned is not a big deal at all. All it is you recognize the current price. If you were behind on your option, you lose that much money that you were behind on the option, then you sell another option and you're not behind anymore. It's not a big deal. When we want to short Tesla, I always want to short Tesla, but I'm scared to short Tesla. Oh, thanks. Good point on the Fed meeting. We've got to pay attention to that. I always want to short Tesla, but they're going to announce. We talked about this in member chat this morning. So why should I repeat it when I wrote it down already? Okay, so what we think about Tesla. They're 50% off the bottom. They hit 140 and they rifle back, and 140 plus 70 is 210. So 210 is a 50% line right there. They rocketed over that. So now they're basically back in the top half, and 210, by the way, that is the 50% line, because if you go from 70, right, so 210 plus another 70 is 280, which is their top. So really, this is the bisecting line of Tesla. Very significant line, and they're over it. So I wouldn't short them when they're right on this line. This is a very bullish line for them. They're clearly breaking up. They've got this car announcement rolling out at the end of the month. And here's what I said. Don't forget they have cheerleading analysts in their pocket who are going to treat the Model 3 announcement like it's the second coming. And they don't have to prove anything. Elon Musk can get up there and say, the Model 3 costs us $2 to build. We sell it for $30,000. It gets 8,000 miles a gallon, and it's going to and it also flies. And everybody goes, ooh, ah, ooh, wow, ooh. Based on that, they're going to make $30,000 a car, and they're going to sell 50,000 cars, and that's going to be $30 billion in profit, and blah, blah. You know, it's all bullshit until they actually make the car. Okay? Tesla is not a company known for telling the truth about cost, production runs, orders, shipments, or anything else. They lie, they lie, they lie, and they lie. Okay? But just because you know that doesn't mean that the millions of other suckers know that. Okay? It also doesn't mean that the analysts who they pay to give wonderful, glowing reviews on their stuff are going to say anything. They don't look. Those analysts are never going to mention the fact that they've been wrong about every target they've ever set so far as a company. They're just going to say, based on this, we can expect, based on, this is what they say, based on what their projections are, we can project that they're going to be worth $8,000 per share. That's what the analysts say. They're not critical at all. Because they're not analysts. They're frickin' PR people. And there's going to be a ton of those guys. Because when you're a multi-billionaire like Musk, and when you have billions of dollars of your net worth is riding on this car going well, you will take people out to really great dinners. Or like Richard Branson. Oh, I'm watching Corey on CNBC. He's a friend of mine, too. It's funny. But Corey on, not CNBC, on Bloomberg. He's so buddy-buddy with Richard Branson. They're actually like making a lunch date. You know, Branson's like saying, I'll take you here when you're on here. When are you going to meet up? And blah, blah, blah. And meanwhile, he's doing a report on his freaking company. But while he's doing a report and interviewing Branson, because Branson doesn't give a crap. And then Branson's saying, I'll do this, I'll do that. Now, Branson maybe is just a nice guy, and he's not doing it to pump his company up, and he's not bribing Corey to do his job a certain way. But really, if the guy's sitting there and flying you first class on Virgin Air to London to meet him at the best restaurant in London, and then you guys are going to go up in the rocket ship after that, you're probably not going to write a really nasty piece about how crappy his whole space concept is. You know? Now, that's the guy who's just genuinely being nice to somebody like Branson. Musk is basically, he's a little bit more hardcore. Musk is going to tell you, like, you do this and play ball with us, this is going to happen for you. You don't play ball with us and your life is going to suck. Okay, and a lot of these billionaires do that, like Icahn or Ackman or people like that. They have their pet reporters who do their bidding, and they get what they want. And when I say reporters, I mean analysts and everybody else. They get what they want when they want to review. They have certain go-to guys. And other guys get frozen out, like Trump. Trump doesn't like the way you report on him. He kicks the reporter out of the rally. You can't follow Trump as a reporter if he doesn't like what you're saying about him. You can follow him, but you can't follow him like from the press section of his rallies. He only gives press passes out to people he likes. That skews the coverage, doesn't it? So if you're a reporter and your job depends on following Trump, and that's your beat, basically, then how is it that how are you going to go out there and badmouth the guy when you're basically going to lose your job? He'll kick you off the beat, and your paper's going to go, well, sorry, you got nothing else for you to do, so you're fired, and we're going to get somebody else to cover Trump because the owner doesn't like you. Or maybe you get pressure from your newspaper to say, cover Trump nicely because we don't want to get thrown off his beat. You know, covering Trump is obviously a commodity for the news people. So that's why you don't get a lot of criticism of him from the people who are actually covering his rally from the inside. Anyway, where were we? Oh yeah, so Tesla. So what I'm thinking about Tesla is you have to realize, so they're going to make this announcement. They're going to spec-wise, you know, they're going to beat every spec the Chevy Bolt has because they already know what the Bolt looks like. That's their principal competition in this space right now. The Chevy Bolt's coming out at $35,000 before rebate, so Musk is going to come out at $28,000 before rebates or something like that, or $32,000 or something. He's going to beat them on every little technical spec that they've got. It'll have a little bit more room and a little bit better mileage and more range and a little bit more this or that. And Chevy says they're going to do $50,000 a year. So Tesla, of course, is going to say, oh, we can do more than $50,000 a year, and Chevy's going to make X, and we're going to make 25% on our cars, which obviously is insane, but they're going to claim it. And I said, even if you do all that, and even if you give Musk every benefit of the doubt, you're still only going to come up to $350 million in profit at $50,000 cars, which obviously they're not going to hit in the first year. They have to ramp up to it. So that would take them. Even then, though, they still have a $30 billion market cap. This is 100 times $30 million. So it's already ridiculous. There's no spot at which you say, oh well, here they were a good long. They're never a good long. They just weren't a good short anymore because they were so far down. I would love to short them. If they get back here, this is the last time we did short them, was 240. So I'd love to see them make another 20, 30. I'd like to see them hit 240, 260, and then I'll be very happy to short them again because it's bullshit. It's bullshit now, though, but it'll be even more bullshit when they pump up. And I think the announcement of the new car, since they have nothing to prove, you know, they can tell you there's magical fairies under the hood, and you won't know the difference until September. So you can say anything you want. So until then, he knows he's got a clean shot at moving the thing higher still. So he should be back around 240, possibly even higher on the excitement of the new car as everybody ups their price target again. But it's a dangerous, stupid stock to play with. All right, anyway, Fed time, right? Oh, God, right there. What's going on? This is not CNBC, this is News 12. I was going to say, why does this station have the Supreme Court judge at 2 o'clock? All right, we're waiting on the Fed. We're looking at the indexes. We'll see what everybody looks like. Are we nervous? Are we happy? A little bit nervous? Everybody's a little bit nervous. Dun, dun, dun. Unchanged. Okay, they're now saying there will be only 2 rate hikes this year, down from 4. We already knew this, though. This is interesting, because this is something I predicted 6 months ago. And that's bullish, because now they're confirming that there will not be more than 2 rate hikes this year. That's a big difference. Basically, what that does is officially, that's cutting rate expectations by 0.5% from even, anybody who's left who thought that they were going to hike 4 times, it's now off the table. So there's definitely a certain percentage of people who are going to be on the wrong side of this trade and have to unwind. So we're going to now get a squeeze up. So obviously, so much for shorting things. As you can see, the dollar took a dive down to 90. All right, so we'll see how far the dollar goes. That's not that far. It's only 0.3 so far. It's going to go lower, though. It's going to go at least a 0.5 point down. So you're going to test the 96 line, possibly below the 96 line on this news. All the indexes are going to slam higher. I don't know how far, but probably good for about a 1% move, which means you could go long in the futures if you wanted to.
The Nikkei doesn't like the dollar going down, so it's kind of flat compared to everybody else. And on the whole, though, these are just going to be good shorting lines. But you see what 1080 is on the Russell? That's your best bet. So if you want to go long, you look at the one who's lagging, which is the Russell. Whoops, active trader. We go to the one that's lagging, which is the Russell. We find 1066. Boy, it went up so fast it blew through the thing. Look at that. So you find 10. Oh, whoa! Look at that thing move. Okay, so we take a long on the Russell here. Nope, didn't even fill. Wow, look at that thing move. There it goes. Oh, see, it filled. Okay. And what we're going to assume is that the Russell somewhat plays catch up. So we started off at 1066.5. And we assume the Russell is going to play catch up because everybody else is now blowing past their highs. Oh, that's gas, so we'll watch that after. So this is the S&P, here's the Dow, and here's the NASDAQ, NQ. Oh, now we're back down here. But I'm assuming, see how they're testing their red line here, testing the red line here, testing the red line here? He hasn't even hit this red line yet. So as long as these guys don't pull back too much, this should be a good long play. So if we're going to have a rally, then that'll catch up. But it's not. It's going the other way, right? Holy crap. The Fed sees additional strength from the job market. Holy cow, that went bad fast, huh? I think that's wrong, though. I think this is coming down for no particularly good reason. 1065. Now, we're only at 1065. We're at 1066.5, so I would like to pick up another one here. Let's add one there. See, now I say this is baked in already, and this is not such a big deal, but we'll see what happens. So now my average is 1065.7, which is right here, and I want to get back to 1 because I'm not seriously caring about this particular trade. But I just added one to lower my basis. Uh-oh, so much for that plan. So now I have two of 1065.7. If I want to get to 1065, I have to go 1.5 below the 2, which is 106.4,750. So 106.4. Is that right? If I added one here? Yeah, that is right. So if I add one here, I'll drop it to 165. Whoa, but it's falling off fast on the Russell. This thing's bucking like a Bronco. It goes right back up. Oh, that's pretty funny. All right, let's add one on the next dip, though. Because the other guys are still going up, so this is kind of silly on the Russell. 104.7. I'd like a little bit lower if I could. I'm being greedy. No, the other guys are turning red, though, so now I'm no longer interested. Got to watch very carefully to see what everybody else is doing. And we already have a lot of puts, so I'm kind of guarding against this thing going up and paying a little bit of money on the long side. Because in our portfolios we have plenty of puts. Whoa! What a joke! Holy crap! There we go. Look at that. There's up. And I get out. And now I'm back to 1, and I have a profit. Not a profit for the day. So now I'm back to 1 at 106.5. That was my plan. All right. So now 106.5 is my long line. I don't have to pay attention anymore. I can go do something else. You see how that works? That's called laddering in and laddering out. You want to get in, get out, and just pick up an extra one. But the idea is to drop your basis. All right, Fed meeting. Do you like AAF? I don't know if I like AA after the spin-off, but I like AA because I like aluminum sales. If I'm going to focus on AA, I want to be the part of the company that still sells aluminum is the one I care about. Because the one thing that Tesla is good for is that the bodies of the new cars have to be made of aluminum. Okay, the Chevy Bolt, made of aluminum. So now you're talking about between Tesla and the Chevy Bolt, you're talking about 100,000 aluminum cars being produced in the next year or so. That's a lot, okay? That's plus the four, and you got the 4 trucks that are aluminum now, and obviously people who want to keep up with them are going to have to start using aluminum too. There's no other material to make a car out of that's going to do that job. So I like that a lot. I think this is a whole new era in aluminum cars that are going to come out. And that's going to be great for AA. Although I'm not sure how they're splitting it up, or I haven't looked at it yet to figure out where the aluminum is going. Volatility, and even if the dollar is going down, when the other indexes prop the NKD. Yeah, to some extent. I'm saying obviously the Nikkei is not going down when the dollar is going down, which is good for the Nikkei. Here's the dollar is now down 96.14 now. So yeah. All right. So the dollar going down is bad for the Nikkei, but because all of our indexes are going up, they're getting kind of dragged up with the other indexes. So over the next couple of months, what's the upside for the S&P now that the Fed is out of the way? You have to understand my predictions for the S&P, which is that will be right around 2000 to 2050 is the base. It's the middle. So you want to pick a middle of the middle. It's 2025. No, I didn't get out at the right time. I left one in. Did it come down more? Oh, 106.3. What is this? See, 17.2 is still holding. I'm not down with this thing. Ouch, 220. Damn it. All right, 106.5. So below 106.3, it gets me to 106.4. So let's go ahead and all right, let's go ahead and add one. Now we're at 106.4. So now I want to get that. See, I've now lowered my basis to 106.4, but it doesn't do me any good unless I get out. But the next time it pops now, I want to sell one. In fact, I've just put in the sell right there, so I may as well do it. Oh, wait a second. Realistically, 106.39. It may get rejected at 106.4, but I should get 106.39. Oh, look at that. Isn't that the stupidest thing? So like I was saying, so now I've got my basis down to 106, it's actually 106.4, so I'm down at that price. So my basis is now 106.4 on the average. But if I add another one at 106.3, I'll drop it down to 106.3. I'm sorry, 106.35. As long as 17.2 is holding on the Dow, I have no reason to worry about this position. The Russell is so far behind, it's reacting short term to what these guys are doing, but in the long run, it should start catching up. All right, so we'll see what happens. But like I said, 2 rate hikes. 2 rate hikes is bullish. There's no way around it. When the Fed definitively says no more than 2 rate hikes, then that's taking. There's got to be. I was in the bullish camp, where I was one of the only people who was saying I only think 2 rate hikes. Maybe by now, about half the people might have joined me. I was saying it at the beginning of the year. I said, in fact, I said in October, I said only the most they'll go up next year is 0.5 point after they do a December hike. But they did the December hike. That didn't go well, and I said, no way are they going to hike more than twice next year. At the time, I was the only idiot saying that. Now, I say probably half the people believe it, but that still means that half the people didn't believe that, and now they're being told for a fact by the Fed that that's the way it's going to be. So they have to now have meetings and change their plans and get more bullish. They have to. They have to adjust their case a bit more bullish. Again, I've already taken this into account, and I think this is the right place for the S&P. But because other people haven't done that, they're now going to panic and start buying things and shove the price up to a bit close to that 2050 mark, at least to 2025. At which point we're going to want to go short again. But right now, at the moment, I don't see any reason the Russell's not going to pop back up. All right, so I'm comfortable with my 1. It's not at 106.2 though. It's at 106. It's not at 106.3. It's at 106.4. So if we get down to 106.2, I would want to add another one. I don't want to add one at 106.3 though. It only drops me half a point. So that's no fun. I don't want to drop a half a point unless I see a clear indication that everybody else is doing well, and we're not because we failed with 17.2 on Dow. We're still holding up nicely on the. We're at 43.73 here, so we're on this red line and this red line, and we're below this red line. And I'm thinking at least they should be holding the pink line, though, if these guys are at the red lines. All right, so we'll get back to that and see what. Oh, wait, 106.2. Didn't I just say 106.2 is where I want to get one? Yeah, I did. All right. There we go. Okay, now my average is 106.3, and I'm going to have a sell-in at 106.29. And now we'll see what happens. All right. How's everything else doing? Woof. So there's the dollar, top, bottom, and now the dollar is coming off its low. That's going to maybe wake up the Nikkei if the dollar starts coming back. So we'll see if 96 holds. On the other hand, though, 96 is obviously going to be a little bit bouncy, even if the dollar is going to continue going lower. So there's no proof to this. It helps, the dollar dropping is boosting oil, of course, it's boosting gasoline a little bit, it's boosting natural gas. TLT is kind of all over the place, but still at the 128, which is where we thought it was going to be. That's where we have a bear spread. Gold is not moving much. That's interesting. Gold's coming back to 1,250, but not a huge move. Well, I guess it was at 1230, so it's a decent move, but not great. And oh, look at silver. Holy crap! Damn it! You know, every time silver's at 1525, we always say, "Oh, we should have gone long at 1525." I guess we're going to have to really admit it that line seems to be holding up really well. It did go lower than 1525, but on the whole, 1525 has been a great line for silver with some big pops off that line. Deanna says, Coke. Coke is good. Yes, I like Coke. Not Coca-Cola. What's your outlook on biotech stock? Yeah. Vertex has killed the sector. Hillary almost certainly becoming president makes him nervous too. So, and the what was that biotech thing that we bought? I think we put it in the 5% portfolio. Oh, look at that! We gained a point in the 5% portfolio. See, this is what I mean about if I'm going to play the futures, I want to offset my bullish position. We're very bullish in the portfolio. We just gained 1% after the Fed. We went from 22 to 23%. What was that thing? Damn it. LABU, here it is, LABU. This is the ultra-long biotech. And they've gotten chewed up, but still the spread is basically even. See how we have a 13, we have negative 13, negative 375, and plus 1175. So on the whole, especially considering always these prices are the worst possible prices for the spread, for the bid-ask spread, we're just about even on this play right now. And we're giving them till till September, sorry. We're giving LABU until September. I think this stuff will calm down, but of course you do have to worry about the election. That's the big bugaboo because Hillary is inevitable, I think, at this point. LABU, and this is a 3 times ETF. So it won't take much of a recovery in biotech for this thing to totally go off to the races. But here's where IBB is. IBM is back in the doldrums. It's probably going to be down here. It might even test 200 or 220 before it really comes back up. So if anything, we'll be adding more to LABU. Doesn't change my premise. If any, we might roll it back in time a little bit. Let the fear and panic of Hillary wash over. But it's the same as Obamacare. You know, the funny thing about Obamacare is when it was coming in 2010, we were, I don't know. I was the only idiot telling people it was going to be great for the industry, and nobody believed me. Stockworld.com, Tale of Two Economies. Here you go. So this is in 2009, when, a little bit after Obama was elected, and Obamacare was just starting to become a thing. I wrote my outlook for 2010, and it was all about biotech. We're talking, see down here, we're talking about IHI, MDT, ISRG, TMO, STJ, SK, SYK, BSX, STJ, BSX. We went on to talk about all these different things in the biotech sector, in the pharma sector, and I was trying to explain that this is good for you. I mean, when you add, when your plan is to add, here you go, 20 million unemployed people are going to start getting insurance. The uninsured will start getting coverage. It was good for GE. TBT was a hospital stock we picked. We picked all these biotech plays. Oh, I'm sorry, that's different. That's Treasury. That wasn't biotech. But we had all these different plays and on biotech because you're going to be adding all these uninsured people who are going to be able to go to the doctor and get these drugs and medications. How obvious is that? You're expanding the base, okay? And what's Hillary, when she comes in, she's all about expanding the base. Yeah, greedy son of a bitch companies like Vertex are going to get killed because she's going to clamp down on abuse and fraud in the system and so on and so forth in order to pay for the uninsured people to be on. That's not a bad thing. There are plenty of honest companies in the biotech space who make perfectly good drugs at perfectly reasonable prices, and they'll do well. It's jackasses like Vertex that get thrown out of the business, but they shouldn't be there in the first place. So you look at IBB, and you got to say to yourself, do I like these companies? So who's in it? The holdings. Here's your problem with IBB, 3.4% Vertex. That means 1.7% of, it was yesterday, this whole index dropped 1.7% because of this one stock dropping 50%. So here's IBB. So the entirety of that drop is Vertex. It's got nothing to do with there being anything wrong with the sector. And then with that poor LABU, because they're an ultra, they dropped 10%. Because of one freaking company. But you know what? That's it. They're gone. Who cares? So now how do we feel about everyone else? Celgene, perfectly good company, Biogen, Amgen, Gilead, Regeneron, Mylan, Alexion, Illumina, Insight. These guys don't have that kind of problem. These guys are criminals. So then they're going to go. It's a shame that the idiots who create this index put them in there in the first place. But that was all part of the, that's all part of the freaking process where the banks completely rip off the consumers. Because by sticking in a stock like that, a hype stock that has no actual business plan other than to overcharge people, by sticking a stock like that into a perfectly good index, they force pension people to buy it. They force all the pension funds that have a biotech investment in through IBB. They force your money into this. So even if you didn't know it, while you weren't looking, your IBB fund started accumulating more and more Vertex while letting go of perfectly good companies in its place. And it became 3.5% of their portfolio. That's despicable in such a short amount of time. But that's how the game is played. So meanwhile, what does it mean? It means there's an opportunity in IBB because because there's nothing wrong with it in general other than the fact that they got sucked up in the Vertex thing. So why play Leibu over IBB? Because Leibu had some fantastic options premiums. Because first of all, IBB, if I want to play IBB, it's still at 250, right? So do I really want to own 100? Do I want to own 100 shares of IBB for $24,000 if it keeps going lower? No, not really, right? But in in Leibu, it's only $5. So even if I do 10 contracts, which is what we did in the options opportunity portfolio, even if I sell 10 puts, I'm only dealing with $5,000 if it goes bad on me. There's no combination that you can make in IBB that lets you make a $5,000 bet. You're making a $25,000 bet on any short puts you sell. So there's that. So there's my much more limited downside, as well as a much faster, more robust upside on a very small recovery because it's an ultra. So yes, if it goes down, I'm more likely to lose my $5,000, but that's better than possibly losing $25,000 on a IBB bet. We wouldn't lose the whole thing, of course, but you know, I'll lose $5,000 just as fast on the IBB bet, but my obligation is so much higher, my margin is so much higher, and my upside is so much slower. So other than that, no reason. I know someone who would put bio as a trade of the year. Did you ever consider it? No, because of exactly what's happening now. Okay, I like biotech. It was my trade of the year in 2010 when the whole thing was, you know, IB. Well, where was IBB in 2010? Let's take a look. Oh, 10 years, okay. Oh, something just filled. I guess the Russell went up. Here. This is when I like biotech, not January 2010. I'm sorry, yeah, it was here, 2009. This is when I pick biotech for my trade of the year. Okay, this, you know, again, it's called a 2010 outlook at Tale of Two Economies. Oh, here, I can do this, I guess. Control C and Control V. And, you know, you can read it just to pick up on the logic of why we were going long and what we were thinking at the time. But that's when I like biotech. And you know, frankly, you know, again, this is like, you know, what the problem, the problem with being a good futurist, which I generally am, is that I can be way too far ahead of things sometimes. So we got in this play early, basically, because I could see it coming from a mile away. So we got in this play early. It took off nicely during the year. It did incredibly nicely the year after that. And, of course, most of our options plays are 2-year plays, so that worked out perfectly for us. But then we're done with it, you know, and I've got no interest. I haven't had any interest in biotech since it did go up to like 300. I didn't want to short it because I still like biotech conceptually. But after that kind of run, everything is very well valued. So to me, it's baffling to say, you know, to be interested in biotech now, when for me, it's like you're 5 years too late. 6 years too late. I mean, when was it? 2009. I read that in 2009. It's 2016 now. So 6, 7 years too late, as far as I'm concerned, to be getting into biotech. We've moved on. We're into materials and natural gas now. You know, you gotta look. You know, it's everybody chases trends because it's mindless. Because this is what bad analysts do. They chase a trend. You know, a good analyst. You know, not to toot my own horn, but a good analyst doesn't look at a chart. You know, that hasn't looked at this flat. Let's see a chart that's flat for years and years of flat, right? A good analyst doesn't look at the chart and see years and years of flat. A good analyst looks ahead at what's breaking in this industry. And at the time, what was breaking the industry, aside from the incredible advances we were making in biotech, was the very solid fact that we were going to be adding a ton of people to the healthcare system. That creates a larger base of patients. That's easy. And I'm telling you that with aluminum right now. We're creating a larger base of cars that use aluminum. Think about a row of aluminum foil, right? Imagine how many of those you need to make one car. All right? And then they have to compress that to a much denser state, too. You know, I'm the one that told you guys gold. It was like, you know, last year we were talking about gold. Gold looks like crap. Here, what's gold? GLD. Oh, this is too long, too big of a chart. 2 years. Okay, so 1050 here. This is my bottom on gold. 1050. So here and here and here and here and here and here and all through here, even though I was wrong because we went lower, I was banging the table on gold. And so from
July 2015 until 2006, until January, so for half a year, I was wrong. Now I'm right. But that's what a good analyst does. A good analyst sees a trend coming in the future. Guys who jump on things that everybody's talking about are not good analysts. They're bandwagon people. There's no skill to that. And following them is the most dangerous thing you can do because you're basically overpaying along with everybody else. A healthy population is good for GDP. Well, that's true too. Obviously, Logan, you are not a Republican because they don't think so. They don't believe in that sort of thing. Value is not Vertex. Oh, sorry. Who's Vertex? That's a different company? Silly me. Oh, that's VRTX. Sorry. Yes, I apologize to the good people of Vertex. It's Valium. It's because there's symbols VRX. I keep thinking it's Vertex. What do you think ABX is worth? Well, ABX has 100 million ounces of gold. Gold is their extraction cost of gold is about $850 an ounce, and gold is $12.50 an ounce. So they're worth 400 times 100 million is $40 billion. So they're worth $40 billion less their debts, which are probably about $12 billion. We can actually look that up pretty quickly. Let's take a look and see. ABX. I wish I could figure out how to get this on my other machine. I love the old Yahoo and I hate the new one. Wow, nice day for them. Balance sheet. Ooh, okay. 20 billion in debt. All right, let's call it 20 billion in debt. All right, so let's say they're worth about $20 billion. So they got $40 billion worth of gold profit. You know, it's gold that can be profitably extracted. At $12.50, they make $400 an ounce for pulling it out of the ground. So they're worth $20 billion, and here they're at $17.2 billion, so they're worth about 20% more than they are now, which is $18. There you go. That's how you be an analyst. It's not complicated. Now, you can give them a premium for this or that. You can assign a little thing for management, blah, blah, blah. You know, all that was taken into account. When I was gung-ho bullish on ABX, that was all stuff we were taking into account. I said, well, look, my logic at the time was, I said, look, even though gold is really depressed, you have the best management in the gold business. They've proven this over the last 40 years, that they are the best people to manage the gold price through the market and whatever. And they did exactly what we wanted them to do. They sold off all of their less profitable mines. They left themselves with their lowest cost production mines. So they sold 40 million ounces worth of their high-cost production mines to pay down their debt. They sold it for about $200 an ounce, so about $8 billion. They collected for selling off 40 million ounces of gold. That dropped their reserves to 100 million ounces of gold, but the 100 million ounces of gold can all be extracted at an incredibly good profit. And that means that, so now they took their value from mediocre, where their average cost was $1,000 an ounce, to incredible, so now their average cost is $400 an ounce. And you know what? Because they're in better position now, and because they're more profitable now, they can turn around and buy other people's profitable mines for good prices and build their portfolio back up. And that's what good management does. And if you want another good management team who does the same kind of things that they do in real estate, that would be Hovnanian, H-O-V. Okay, and Hovnanian is now trading at about $1.50 a share, $1.40 in fact a share. It's the same thing. It takes years to turn these companies around, but it's the same thing. They're getting rid of their unproductive land. They are buying more productive land. They're planning for the future. They've got a board that they have 12 years worth of projects lined up on a board. You know, these are long-term planning companies. They're not like, they're just in a depressed cycle in the market. It's a cyclical business, and they're in the down part of the housing cycle. When the cycle comes back up, they're going to come back incredibly. And that's because, wait, chart. No, not that chart. Damn it. All right, well, anyway, so if you look at the longer term, oh, well, let's go back. So now look at TUB on this chart. H-O-V. Well, now Yellen's saying stuff. Oh, forgot about that part. Whatever nonsense she's spouting.
Okay? This is not the first time they've been in a down cycle, but look what happens when they hit an up cycle. All right, so I like them. I want to be here, even if this takes 10 years and they languish for 10 years down at these low prices. I want to be here for this ride. And if I have to wait 10 years to get a 10 times return on my money, I don't mind that still averages 100% per year. And frankly, they only need to get to $14 to make 10 times on my money at this point. So they get back to here. See, this is where we want it to be, $14 right here. Here. No, lower. Lower, lower, there. All right, anyway, right around here. There you go, $14. So we wanted to get to there, eventually. We're in a down housing market, up housing market, down housing market, waiting for the up housing market. Doesn't even have to go up that high because we're at $1.40. You got to be patient with plays like this, and you have to understand their business and understand the cyclical nature of it. Same thing with cliffs, right? Then we've been accumulating cliffs, and we have a pretty big position in them. CLF. Huh? Silly. CLF. Same thing. Down cycle, up cycle, down cycle, up cycle, down cycle, waiting. All right, but that looks bad, but if you look at the last year, okay, we had a nice little pop. We went from $1.50 to $3 briefly, pulling back to a more reasonable. Now, if $1.50 is the bottom, where's $1.50? If $1.50 is the bottom, then 50% more than $1.50 is $2.25, right? If $2.25 is holding, this is just like Tesla, if $2.25 is holding, that's the 50% line. And that means this was a bit too high. It's going to consolidate here, and if it consolidates in the top half, you may get a break to a nice high number here. I like cliffs too, though. They produce iron ore pellets in the United States. They're the only ones doing it in North America. They have a huge shipping advantage over China, and we just put tariffs on the Chinese imports. What's not to like? But that's why I like these stocks. They're fundamentals. There's something driving these stocks that's going to kick in over time. That's why you buy a stock, not because the chart does this or that, or some guy says this or that. All right. Meanwhile, what's Yellen doing to our stocks here? I still have a bet on, don't I? Ooh, 106.77. I don't even remember what I have anymore. Oh, really? Look at that, $400. Take it. Thank you, thank you, thank you. All right. Thank you, Janet. I'm good. Hey, $390. All right. Who else makes you $390 in a half hour? What webinar do you tune into to do this for you? All right, so we'll call that good. $390 is good money to make for a webinar. I feel like I've done my job for the day. And again, just logic. I didn't care. You see, the chart wasn't really going my way at first, but I just wanted to lower my basis because it's not so much a premise as it's really obvious to me because, we pay attention to what's going on, that was bullish. Okay, it's just math. If you understand the things you're playing, it's just math. And Warren Buffett says, very rightly so, never invest in anything you don't understand. I had a very, very simple premise just then. As soon as they made that announcement that they were definitely going to be no more than 2 hikes, I didn't need to even read the report. Notice I didn't bother reading the report. All I need to know is that they say there's definitely going to be no more than 2 hikes this year. And I know for a fact that because we pay attention previously, not because it's something we do watch. We know that 2 is the low end because 2 is my number. So we know that 2 Fed hikes were the low end of the spectrum by far. And that means that there's so many people on the wrong side of that, they have no choice but to shift themselves more bullish. And so
I know even when the thing was going against us, I know it's time to buy more, not to chicken out, because I know what my premise is. I know what I'm betting on. I understand why I'm in the position. I know what I'm waiting for to see. And what was my logic in picking the Russell? Because the Russell was the most behind. Everybody else is up at their red lines here, red line here, and red line here, the S1 line. No, I'm sorry, the R1 line, resistance one. And the Russell was there, was below its pink line, the midpoint. Therefore, logically, it would be an easy thing for the Russell to pop up. And had I been paying attention, we could have gone out to 1070, which is an obvious exit point. They cleared all the way up to 1070. Let's see if we actually hit it. Look at that, right on the frickin' button at 1070. Damn it. Oh well. Anyway, so we even left a couple $100 on the table with that trade. But still, making $400 in half hour, that's always good money, right? Especially if they're not paying attention while I'm bullshitting about other stuff. And that, that's how we want to play the futures. That's how you want to play stocks. All right, I get a lot of people play stuff, and they, a lot of people play stuff, and they ask me questions that clearly indicate that they have absolutely no idea why they're in a stock, other than some guy said something. And look, even if I'm that some guy, if you don't understand it, don't play it. You got to know why you're in a trade, exactly why you're in a trade, and what you're going to do with the trade. And you have to understand when you read the news or something changes or a headline crosses a board, you have to understand its effect on the position you have. Because that way you're going to react better and you're going to make better decisions. It's the simplest thing in the world, though. If you don't know it, don't trade it. And you will improve your performance tremendously. Tremendously. And it should be the most obvious thing in the world, okay? Because I was thinking, if you want to go win a board game, play a game you know, right? Don't play games you don't know. You're going to lose because you don't know the game. It's intuitive, right? It's hard to even imagine I have to explain that to people because that's essentially the level we're talking about here. For some reason, people think a stock is a stock. And it makes no difference whether you're playing Valiant or whether you're playing GE or whether you're playing Alcoa or whether you're playing Ford or whether you're playing Disney. How could that not matter? And then you have idiots like Kramer who say diversify, diversify, diversify. Diversifying is fine, but not if you're diversifying by forcing yourself into stuff you don't understand. That's like saying, like, look, most of you guys, you train for 10, 20 years for some job or another, right? You all got really good at some job. Should you diversify and do other jobs that you're not good at? Or should you get better and better at the job you're good at? It's so much easier to do what you know and stick with what you know. And from there, you'll learn other stuff and get better at other things. As I said before, I started out, my father was a systems analyst. I was always into computers. I started out playing computer stocks and chip stocks back in the 80s. That was my first stocks when I graduated college that I was picking. From there, though, I got into retail. And then retail caused me to get interested in shipping. And then shipping got me interested in the energy sector. But all these things evolved naturally. It's because I understood the chip stocks and the computer stocks, I understood the computer stores and the tech companies that were growing up around them. Then from that, I started understanding a lot more about the retail sector. Then from understanding the retail sector, I began to understand, I started looking at the logistics of the shipping sector. As I began to understand that, I started to understand how the shipping logistics started affecting the price of oil around the country. And then when I started learning the price of oil, other things. And that's why here we are 30 years after the fact that I now know a lot of stuff. But I still don't know anything about biotech companies. That's why I always defer to Farm Boy on that. I'm like, to me, that's all just a black box. I play most biotech like, it could go either way. But him I trust. He's my analyst, and I trust him. And if he says something good, and I like the way there's a way to make a play out of it, then I'll take a bet. But I always treat them like craft bets. I always treat them like they could go either way because I don't know it, and I don't play it. And you'll see it's not a big part of our portfolios in general. Back in 2010, I picked stocks in conjunction with his recommendations because we saw an opportunity to go heavily long on biotech. All right, but that's a done trade. It's 2 years, it's 5 years old now, 6 years old now. You've got to play things that make sense to play, that you understand why you're playing them, why you're in them. The worst thing people do is chase hot sectors and hot things and this and that. It's like, why? There's always something to trade in what you know. You all are experts in something. Look at the places where you understand the businesses and find the undervalued places there, or find the overvalued ones and short them. So that's how you play the market, not just chasing after whatevers. All right, do we have a current play on CLF? And what's the medium-term view of the dollar? The dollar, I think, is perfectly fairly valued up here near 100. And, well, as we see today, it doesn't take much of anything from the Fed to drop it. Everybody says the dollar should be strong, whatever. I think it's already strong. The dollar at 95 is a perfectly reasonable price, somewhere around 95. Shouldn't be much lower. Maybe 97.50 would be about the right price. So, again, the dollar I find very uninteresting where it is now, because it's right in the range it should be at. I certainly don't see how it's going to go over 100 unless Britain exits the euro, which is most likely going to happen. And when Britain pulls out of the euro, I think that's going to start a slow but sure collapse of the euro, and that's going to knock the dollar over 100. But not because anything the dollar did, only because the euro is going to completely fall apart and people are going to have nowhere else to go. But we'll see that happen later in the year. Current plan clip. Okay, last thing we do, because it's already 2:45, and AG's asking one more question. SDS, SQQ, reasonable now to protect. Yeah, sure, of course I still like them. And Brexit, what happens to SCG? Look, I can't tell you for sure what's going to happen on these things, but I think in general that the British exit is going to cause such pain in the euro that the other countries are going to start walking out. That other, because don't forget, England is let's say England's got to be at least 10, probably 15% of the European economy. So when the ECB decides that they're going to help this country or do that, it's like a tax that England has to kick in the money for, right? And when the ECB is printing money like madmen, they're devaluing Britain's currency. Okay, so they're devaluing. The pound is going to go up, of course, if the euro goes down. But they're devaluing, so the pound will get stronger, even though England has the ability to print pounds. They're probably not going to really exercise it, and certainly not to the extent that Draghi's printing money. And then what's going to happen is as the euro falls apart, because the pound is an easy exit, an easy trade for people in Europe, they're going to jump into the pound, and it's going to go up probably more than it should. Versus the dollar, no reason the pound should be stronger than the dollar. So it depends on how you're playing it. The pound-euro, I think it's going to be a huge thing for the pound. But you're going to see country after country are going to get fed up, probably starting with France. France, as much as they're protesting England leaving now, will probably be the first one to leave after England does. Because these are the countries that Germany is the euro. Germany doesn't want to leave, but they're going to, they're going to get really pissed off supporting all these other countries. But England and France are with Germany. They're like getting tapped every time that you have to help somebody. Every time you want to devalue something, it's always England and France that are shipping the money along with Germany. So as much as Germany complains, they get the most benefit from the euro, from all the trade partnerships they have and all the other countries they work with. England just doesn't get enough of a benefit to make it worth their time right now. And France, France is 50-50. But getting saddled with all the bad economies, it's not worth it for anybody. And once England leaves, all of a sudden the burden on everybody else gets worse, and that's going to be the beginning of the end. All right, last question, really. Cliff. Okay, yeah, well, that's easy because, again, I love $5 stocks. Any stock that's down around $5 usually has great options because they tend to over-exaggerate the options. So Cliff's is right now at 240, not even 5. And you go to 2018, you can sell the $1.50 puts for 95 cents. So they're basically priced for bankruptcy. So you sell the $1.50 puts for 95 cents. Your worst case is you buy them for $1.50. That's $1 off. That's 40% below the current price. All right. So your worst case, if you get 95 cents, then you take that 95 cents. Whoops.
You take that 95 cents. You can buy the $2 calls and not do anything else. I would buy the $1 calls if you can get. I assume these prices are right. It's a little bit much though. If you pay $1.60 and you sell the let's say you sell the $3 calls for like 75 cents. So that's 95 cents. So in other words, that's net zero. So you sell the 150 puts for 95. You buy the dollar calls and you sell the $3 calls for 95. That's net zero on the trade. So you spend nothing. Your worst case is you own cliffs for $1.50, which is 40% off the current price. And your best case is it's $3, which is only 50 cents up from where it is now. You make a $2 profit. So how's that for a trade? So let's say we want to commit to buying $3,000 worth of cliffs. All right, that would be 20 contracts is $3,000. Then 20 contracts will pay you $4,000. So your worst case is you're going to buy $3,000 worth of cliff at a 30% discount to where at a 40% discount to where it is now. That's your worst case. If you'll have 2,000 shares of cliff for $4,000. 2,000 shares of cliff now cost. You'll own 2,000 shares of cliff for $3,000. That's your worst case. Currently, 2,000 shares of cliff is $5,000. Your upside is that you'll get $4,000 in cash if CLF is at 3. That's a great trade. Your risk, not only that though, even if they flatline, even if they fall back to $2, you still get $2,000. If they fall 20% from where they are now, you still get $2,000 profit. It's a great trade. That's how we play stocks, okay? We protect ourselves and we make aggressive longs at the same time. Well protected and aggressive. It's almost like you can't, it almost seems like you shouldn't be able to do things like that, but you can. That's why I love options trading. And what a great place to end the seminar. All right, thanks for coming, everybody. This was a very fun session. We made $400. That's always good to do. And we found a couple of great trades. Have a good day, everyone.